Here's the numbers first rundown on a choppy market session. Big picture. U.S. stocks slipped after a fresh wave of earnings hit before the bell and late yesterday. The three major indexes are in the red as traders digest guidance more than headlines. Breadth is weak, more decliners than advancers, with defensive pockets holding up better than high beta names. Earnings pulse, top movers. Netflix is down after its latest report. The story isn't the past quarter, it's the outlook. I'm watching three dials: paid net ads momentum, average revenue per membership, ad tier traction. Markets are punishing any hint that growth is slowing while content spend nudges higher. Mega cap tech is mixed. Cloud exposed names diverging. AI infrastructure names diverging. Digital ad related names diverging. Financials are split. Card issuers and consumer banks are flagging credit normalization and higher loss provisions. Trading heavy banks look steadier. Sectors, quick scan. Tech, pressure on consumer internet. Tech, pressure on streaming. Semiconductors more resilient but choppy. AI hardware showing resilience but choppy. Communication services, weighed by streaming. Communication services, weighed by ads. Communication services, select platforms bucking the trend on better engagement metrics. Staples and healthcare, relative strength as investors hide in cash flow visibility. Energy, tied to crude swings. Energy, refiners trading the spread. Energy, integrateds trading the spread, not just spot. Rates and dollar check, yields are firmer on the front end, adding headwinds to long-duration growth names. A steadier dollar is a drag for multinationals with overseas revenue. Options and flows, implied volatility is elevated into the heaviest part of earnings season. Flow is defensive, more put hedging and selective call buying. What matters in today's reports? My quick filter. 1. Top line versus guide. Beats without confident forward commentary are getting sold. 1. Margins. Gross margin expansion is being rewarded. OPEX creep is punished. 1. Cash. Free cash flow and buyback capacity are trumping headline EPS. 1. User metrics. For platforms like Netflix, subscriber quality and ARPU matter more than raw ads. For Netflix specifically, here's the scoreboard I'm tracking this quarter and next. Net ads trend versus last quarter's surge. ARPU direction in ads-supported versus premium tiers. Content spend cadence and slate timing into the holiday window. Churn impact from pricing and password sharing policies. Any wobble on those dials explains the stock's drop more than the print itself. Traders' to-do list before the close. Recheck guidance tables, not just the press releases. Listen for margin and capex nuances on calls. Watch leadership. If defensives keep leading into the afternoon, dip buying in cyclicals may stay shallow. Keep an eye on the 10-year yield bounce zones. Duration sensitivity is dictating tech moves today. For Netflix, look for sell-side estimate revisions over the next 24-48 hours. That often sets the next leg. Bottom line, it's a guidance market. Beats are nice. Believable forward paths are what move stocks. If you're trading, size down into earnings, let the first reaction settle, and trade the second move when the guidance dust clears. I'll keep it tight and update as more numbers hit the tape. Stay nimble.